Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding the VIX, what the volatility index means for investors in 2024. Ever wonder how investors gauge fear in the stock market? That's where the volatility index, VIX, comes in. Known as the fear gauge, the VIX measures expected market volatility over the next 30 days. It's a critical tool for investors to understand potential risks and market sentiment. Whether you're a beginner or a seasoned trader, knowing how the VIX works can help you make smarter decisions in uncertain markets. Let's break it down. What is the volatility index, VIX? The volatility index, or VIX, is one of the most recognized tools in the financial world. Often called the fear gauge, the VIX gives investors insight into expected stock market volatility over the next 30 days. It's not about predicting market direction, whether stocks will rise or fall, but rather how extreme the price swings might be. For traders and investors, understanding the VIX helps them prepare for uncertainty and adjust their strategies accordingly. History and development of the VIX. The VIX was introduced in 1993 by the Chicago Board Options Exchange, CBOE. Initially, it measured implied volatility using options on the S&P 100 index. The concept was revolutionary, offering a standardized way to measure market fear and sentiment. As markets evolved, so did the VIX. In 2003, the CBOE updated the VIX calculation to focus on S&P 500 index options. This change made the index more comprehensive, as the S&P 500 represents a broader section of the stock market. The update also helped the VIX become a global benchmark for volatility. Over the years, it's gained widespread attention, especially during financial crises, when it spikes to reflect market alarm. Today, the VIX isn't just a barometer of fear. It's also the backbone of various financial products, like VIX futures and exchange-traded products, allowing traders to hedge against or profit from volatility. How VIX is calculated. The calculation of the VIX might sound complicated, but the concept behind it is simple. It measures the market's expectations for volatility. It does this by analyzing the prices of near-term S&P 500 options, contracts that give the right to buy or sell at a specific price. Here's an overview of how the VIX is calculated. Focus on options prices. The VIX uses a wide range of call and put options from the S&P 500 index. These options reflect what traders think the market could look like in the near future. Implied volatility. Instead of looking at historical data, the VIX relies on implied volatility. This represents the market's anticipated volatility, not what's already happened. Weighted average. A formula takes these option prices and calculates a weighted average. The end result is expressed as an annualized percentage. Put simply, the higher the demand for S&P 500 options, the greater the implied volatility, and the higher the VIX number. When the VIX is low, it usually signals a calmer market. On the flip side, a high VIX points to nervousness and potential turbulence. Breaking down the formula might feel technical, but at its core, the VIX reflects how uncertain investors feel about the market's short-term future. It's like a weather forecast for financial markets, revealing whether traders expect sunny skies or storm clouds ahead. Why VIX matters to investors. The VIX is more than a number, it's a lens through which investors can interpret market behavior. Whether you're bracing for turbulence or looking for smoother sailing, the VIX helps you stay prepared. Its importance lies in its role as both a compass for market sentiment and a guide for managing risk. VIX as a market sentiment indicator. Think of the VIX like a market mood ring. Its movements reveal the collective emotional state of investors. A low VIX signals confidence, stability, and calm waters. When the VIX spikes, it's like an alarm bell, reflecting heightened fear and uncertainty in the market. Why does this matter? Because market sentiment drives behavior. When fear is high, investors may panic, sell, or hedge their positions. During periods of calm, they might become more aggressive, taking on more risk. The VIX gives you insight into this psychological undercurrent, so you're not caught off guard. For example, during times of economic or political turmoil, like recessions or unexpected geopolitical events, the VIX often surges. On the flip side, in stable markets with strong growth, the VIX tends to stay low. Watching this index helps you read between the lines of market activity. Is a sell-off rooted in fundamental problems or just temporary panic? The VIX gives you clues. VIX and portfolio management. When it comes to managing your investments, the VIX is like a weather forecast for risk. A rising VIX isn't just about fear, it's a signal that volatility, and therefore uncertainty, could increase. Investors use this information to fine-tune their portfolios. Here's how the VIX can guide portfolio decisions. Risk assessment. A high VIX might prompt you to reduce exposure to riskier assets like stocks. Hedging strategies. Investors often use derivatives tied to the VIX, like VIX futures or options, to protect their portfolios. Asset allocation. During volatile times, you might shift toward safer havens like bonds or cash to preserve capital. For example, let's say you see the VIX climbing rapidly. This may indicate potential market turmoil ahead. You might tighten your strategy by diversifying further or reallocating funds to balance risk versus reward. But don't make the mistake of acting only on the VIX. It's one tool among many, and it doesn't predict exact outcomes. Instead, it helps investors prepare. Just as sailors adjust their routes based on a weather forecast, you can adjust your investment strategy when the VIX signals a storm brewing. Trading the VIX. Trading the VIX opens up unique opportunities for investors looking to hedge risk or profit from market volatility. Unlike traditional stocks or bonds, the VIX isn't an asset you can buy directly. Instead, traders gain exposure through specialized financial instruments and well-planned strategies. Let's dive into how trading the VIX works. VIX options and futures. When it comes to trading the VIX, options and futures are the two primary tools. These contracts allow traders to speculate on or hedge against future changes in volatility. VIX futures. Futures contracts tied to the VIX let traders bet on where the index will go at a specific point in the future. For example, you might buy VIX futures if you believe market volatility will rise. These contracts don't track the VIX spot price directly but are based on expected future values, which makes them ideal for predictions during uncertain times. VIX options. Options give traders the right, but not the obligation, to buy or sell VIX futures at a set price. Calls are used when anticipating a rise in volatility, while puts serve if you expect it to fall. Since options have limited risk, they're often favored by those wanting controlled exposure to the VIX. These tools are traded on platforms like the CBOE, Chicago Board Options Exchange, and attract investors ranging from individual traders to large institutions. Keep in mind, however, that these instruments require a solid understanding of derivatives. Other vehicles like ETNs, exchange-traded notes, and ETFs, exchange-traded funds, tied to the VIX are also available. These products offer simpler access for those who aren't ready to dive into the complexities of options or futures. Strategies for trading VIX. Trading the VIX requires more than just knowing the instruments, it's about using them strategically. The VIX behaves differently than stocks, so it pays to understand its nuances. Here are some common strategies traders use. Hedging against market drops. When markets tumble, the VIX tends to spike. Investors often buy VIX call options or futures as insurance for their portfolios. This way, the profits from rising VIX values can offset losses in equities. Think of it as a safety net when fear dominates the market. Playing short-term spikes. Some traders aim to profit from short bursts of volatility. For instance, during earnings season or political events, uncertainty grows, and so does the VIX. By closely watching news and market trends, you can capitalize on these temporary moves. Mean reversion strategies. The VIX has a tendency to revert to its average over time, especially after extreme spikes during crises. Traders often sell VIX futures or buy put options after significant spikes, expecting volatility to cool down eventually. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.